Saibal, thanks a lot. You're coming on the channel for the first time, so welcome to the channel. Let me start by your assessment of the valuations of the market at current levels. One section of the market believe that market is not really inexpensive. What is your own view?
See, I think at 16 one-year forward multiple market would be roughly near to its long-term average, maybe a little higher than that. In the medium term, I think the demand-supply situation can turn unfavorable for the equities, because if I do just a back of the envelope calculation, all I see, taking into account the PSU disinvestment program as well as the IPO in the pipeline, around about 70 to 75,000 crores of supply is going to hit the market in the rest of the financial year, and I think that's going to cap the upside from here. However, in the long run, I'm extremely bullish on equities, because I believe it's a great inflection point which is in favor of equity, and one has to allocate a substantial part of his investments in equities with a long-term perspective.
And Saibal, the general investing community has turned cautious on the market after looking at IIP as well as the CPI last evening. Some even worry of a rate hike by year and by the end of this year.
See, first come to the IIP number. I think, yes, it's disappointing. And it's more disappointing because the consumer good numbers have also slipped in the month of June. But from a fund management perspective, at the end of the day, these are historic numbers. What I'll be more keen to look at is the PMI number, which tells me about GDP going forward. And in PMI for last couple of months, we have seen some traction in both service PMI as well as manufacturing PMI. The composite PMI has also been resilient at an expansionary zone. And the other, of course, the lead indicators like auto sales or the business confidence data and all those stuff. Everything put together, I think these are going to translate in better IIP numbers and GDP numbers going forward. Coming back to CPI number, yes, I think if I see the CPI basket, except the food items, the rest of the CPI basket is well below 8%, which is RBI's threshold for January 2015. Maybe it's a bit too early to conclude that there will be a rate hike on the basis of the CPI data.
And Saibal, looking at these macroeconomic data coming in now, what is your own GDP growth estimate for next 1 year forward?
I'm not an economist, but I guess it would be around 5.2, 5.3 level for FY15.
Right, but what are your overweight and underweight positions right now as far as your portfolio is concerned? Give us some flavor of your positioning at your fund.
From the positioning perspective, we are heavy on cyclicals because we believe, and as I said, that we are at an inflection point from where there is an upside for equity over a longer period of time. And if market goes up, obviously cyclical is tend to outperform. Having said that, though, I agree that post the recent rally, the gap between the cyclicals and the defensive have narrowed down, and we also find sometimes quite a struggle to find stocks where at a reasonable valuation with a good potential going forward. But cyclicals is something where we are heavy, and especially auto, banks, those stocks which should be the early recipient of the GDP or the economic growth. That's where we are overweight. But also you must understand that at a time when market is at 16 times P, you also have to take some bottoms up call, because without that creating alpha would be a little difficult in a portfolio.
Right.
So that's where we are.
Right. Saibal, among defensive, what is the order of your preference? IT, pharma, FMCG, how would you rate them in your fund?
See, our mandate is diversified and conservative. So when we are betting heavy on cyclicals, to balance that, we also have to, it's like buying a bit of insurance in the portfolio. That needs to be built in. And that's built in the form of IT, because we believe that at this point of time, IT, the underlying, apart from currency hedging, the underlying business traction is very strong. and the valuations are also not too expensive. So we are also heavy on IT at this point of time.
And Saibal, among the cyclicals, what is your order of preference amongst autos, banks, capital goods and some of the others?
So we are very positive on auto, we are positive on banks, and we also have some deep cyclical stocks. But I guess they are going to play out in the second phase of the growth.
And how are you positioned in the mid-cap fund?
So mid-cap, I think our approach is more bottoms up than sector specific. But basic of our philosophy, the basic philosophy of our buying mid-cap stock is that we don't buy a stock which you don't understand. So obviously, the stocks where we have conviction, we are heavy on those stocks. I can't give specific names, but yes, we are there.
Finally, leave us with your assessment of how you're looking at the first quarter earnings going forward. Where do you think the earning trajectory would go of corporate India from here on?
Look, I think the first quarter earning till date is quite on expected lines. The export-oriented stocks, both pharma and IT, have done well. FMCG, the numbers are fair. We also have seen some traction in the bottom line and top line of quality banking stocks. Auto stocks have done well. The deep cyclical stocks have not done well, and it's not expected either, simply because both the investment cycle and the interest rate cycle have not yet turned. On the basis of first quarter number, it's very difficult to extrapolate. I would not go by that. I think our estimation is there, which is based on the GDP growth going forward, and that remains.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.